Industries and Dhanuka Agritech and hold call on bear crop and reduce call on rallies. It says both UPI and PI industries have least exposure to domestic businesses, and the sign of recovery for both UPI and PI industry in global agriculture is positive. Also, higher area under crop showing a definite positive, and strong rains likely to moderate growth in Q2 for agriculture players. Also, good rainfall to boost water storage supporting H2 FY25 domestic sales growth, and total overall FY25 expect a healthy growth for agri-input companies.
All right, we're just a couple of seconds away from market open, so thank you very much for that. First rates coming up. I mean, it will not be, at least the pre-open is not indicating a 100-point start higher as the GIFT Nifty was. It's a more modest 50 points, and then we'll pick up from there. So the first indication is a 50-point start and a 100-point start in the Sensex. So what do we have? So 25,253, that's about 0.2% higher, 0.2 on the Sensex as well. We're at about 82,558. So these are the first rates which are coming through. 42 on the Nifty actually, and the Sensex looking up as well. The Bank Nifty is up 0.25%. We're back above 51,500. The mid-cap index is up about 0.4. So it's a quieter kind of start, which we are looking at. Market breadth is looking pretty positive. 7:1 is the advances to decline ratio. And of course, the heat map on the Nifty, 10 stocks, 10, 11 stocks are lower, but you've got the majority, the bulk of it, opening up in the green. Surabhi.
Okay, so let's take a look at the movers on the upside. You have Ultratech Cement to kick things off. The top mover on the Nifty right now, there's Hindalco. There is Tata Steel. So basically, some of the metal names and commodity names are doing well. Even JSW Steel managing a little bit of a green. And there's ITC on the upside. There's LTI, Mindtree and Wipro from the tech space as well. So very, very mixed trends on the way up. On the way down, there's some cool off in the so-called defensive trades. So Nestle and Britannia, they're down about 0.5%. Not too much, just about 0.5%. The Bank Nifty is actually doing quite well. Bank Nifty is up 180 points. HDFC Bank, ICICI Bank are leading the charge from the front, with a gain of about 0.5%. There's Axis up as well. So banks are looking good. And Reliance, like we said, it's in focus for multiple pieces of news, including, PLI for some of their expansion plans, as well as the bonus meeting today. 1:1 bonus will be considered by the board. Reliance is the third top performing stock on the Nifty now.
Well, that's right. The big mover this morning is Chola Investment on the back of a GS note, as well as GS note on AU Small Finance Bank. So both those two, they are the biggest movers today. AU Small Finance now, it's one of the top gainers. It's up close to around 4% and on big volumes. And Chola Investment as well, that one as well is flying away as we speak. So big up move is what we're seeing on both those two names. From the broader markets, another one that's doing very well is NIT. Oh, that's gone from strength to strength. I think around 3 weeks or so ago, it was less than 150. Now it's more than 200 rupees. Stock up 6% as we speak. Massive up move is what we're seeing out there. Suzlon Energy, the street likes what they're doing with regard to selling that asset and leasing it back. So stock is up close to around 3%. Good move is what we're seeing on that one. We have a large trade on Max Financial, but 3.5% equity changed hands. So that explains why that stock is down 2%, but it's quickly bounced off the low point of the day. So those are the top movers in trade today. Alembic Pharma as well is up close to 2.5%. Zomato is bouncing back. It's up close to around 2% as we speak. So pretty good looking screen. It's not the 100 points that the GIFT Nifty was suggesting, but par for the course. We're up 50 points. We bounced up 100 points from yesterday's low. Put it together, 150 points up from yesterday's lows.
ECOS Mobility, the listing from yesterday is up 7%. And it's the second largest volume-led gainer in the market today. It had a decent start. I mean, about 17-18% higher day yesterday on day one. Not as big as we've had with a few others, but good enough. ECOS Mobility, I mean, that's the one I'm talking about. So 476 on that one. So AU and Chola, of course, are the big 4.5% and 4% movers. So both have got very large volumes. We mentioned NIIT, which is coming up at number 4 with volume-led gains. There is Linde India, which is up about 3% or so. IIFL Securities has been having a bit of a move last few days. It was a big one yesterday, and it's up about 3.5% this morning as well. What else? You've got PG Electroplast, which is up 4%. So that's coming at about 590. That's from the EMS space. Kernex Microsystems is up about 4.5%. Again, a stock which is actually which sold off, but is now trying to make a bit of a comeback. And there is Fino Payment Bank, which is also up about 3.6%. I can spot a Zaggle, which is up about 2%. But that's it. I mean, you go down the list and volumes start to fade away pretty quickly. Max Financial, of course, that block, and volumes are outsized because of that block coming through at this stage. Garden Reach, some of these shipbuilders, right, from yesterday, which were big movers, they are seeing some profit booking, but not very much. Look at the Max Estates. Max Estates is down sharply. It's down 4%, 630, and it's coming up with some volumes as well. So I'm just only highlighting that because there's been this block in sort of Max Financial Services as well. So I'm not sure if there's any, rub off, but why should there be? But it's down 4.5%. Uno Minda is down about 2%. Marico is down 1/3%. Cummins is down 1%. So that's essentially the lay of the land for now. 1,700 stocks are higher, and you got 400 stocks which are up in the green at this point in time. Well, we have our market master of the day with us. Mahesh Patil is joining us. Mahesh is Chief Investment Officer, Aditya Birla Sun Life Asset Management Company. Mahesh, good to have you with us here. Thank you very much for your time. Mahesh, let's just get a quick sense on this entire flows picture. At a net level, what is the industry averaging at? If you can give us the latest, for this month as well. Are flows holding on both on the SIP and discretionary side, and where exactly is the money going?
Yeah, good morning, Vishal. So I think the overall in the last 3 months, we have seen that the net flow numbers for the industry have been clocking a much higher number than what it was average of last year. And I think that broader trend continues, it seems like. I think we don't have the exact number for last month. But I would say clearly the net flows still remain fairly strong. The SIP flows are strong. What is the trend? What we saw last couple of 2 to 3 months is that out of the net inflows, large amount of money came in the thematic funds, right? So there were a lot of these NFOs which were there on the thematic side. And that's where the larger, more than say around 40% of the inflows were in that category. But one interesting trend, possibly what we are seeing is that there is some interest coming back into the hybrid funds, and also some inflows coming into the flexi cap and the large cap category, compared to say last year, where we had seen this category was totally ignored. So I think that's a kind of a subtle kind of a change of what we are seeing. But by and large, I think the money inflows into the markets, into the mutual fund industry seems to be still on a steady wicket.
Oh, absolutely, Mahesh. That's the big trend that we've witnessed over the last couple of months now, right? Thematics is where the action is, and that's where the money is coming in. But, what about valuations? Because obviously there is product innovation on that side, and you're seeing, and now there are a lot of passive products, passive thematic funds that are coming in as well, and they're bringing in the money. So what about valuations in some of these themes like defense or manufacturing or infrastructure? Because this is where we've seen a fair amount of, newer products as well when it comes to thematic funds. So how do you see valuations in these specific pockets?
Yeah, so I think in some of the themes, clearly they have there's a lot of fancy which has been there, and we've seen a lot of money chasing some of these themes. And a broader market, if you look at it in the sectoral themes, in some of the pockets, the valuations have moved ahead. But I think some of the themes which have come in, also the outlook there, right? One has to really look at the long-term outlook on this theme is still really good. So there could be period of pause, or there could be period of consolidation in some of the themes, and investors who are coming into these thematic funds should really look at on the perspective whether where you are early in the theme or the mid cycle of the theme or in the late cycle. So clearly, if you're in the late cycle, then clearly one needs to be very careful. But even if you're in the mid cycle, I think that should still be okay if you have a slightly, say, with a 2 to 3 year view horizon. But I think I would say that it's time now to really look at more the diversified fund, right? Because as I said, in the last 1 year, we've seen that the market breadth has improved significantly. So a lot of the side of the market has gone up significantly, and which is also reflecting the fact that if you look at the number of stocks, okay, say in the BSE 500, which have kind of outperformed the BSE 500, say by at least more than 10%, that number is the record levels. And that's because of some of the themes, the sightings which have played out. And that's where the valuations are looking a bit stretched. But if you look at the broader Nifty, right, there the valuations, if you compare to FY19 levels pre-COVID, and now it's only about 7-8% higher. So I think that's where the larger comfort is. So I think it's time where people start putting money into the more diversified fund where the risk mitigation would be much better.
Right. I just want to quickly highlight Zomato. It's taken off like a rocket. It was not there in the mix earlier when we sort of were looking at the stocks and what was moving. But the Zomato intraday will come up on your screen and look at that. So actually there was a lower start on Zomato and then it has moved up to where it is now, which is a full 10 rupee turnaround coming through on that one. The other one is Edelweiss. I just want to make a quick mention. Edelweiss, I mean, the low yesterday was $104. It was a late surge on Edelweiss yesterday, ended up about, I think, 4%. It's another 3.5-4% this morning. So just sort of two new names into the mix this morning. But there is lots more in terms of individual names which are coming through. Nigel.
Yeah, all right. Well, hi, Mahesh. Good morning and good to see you, Ben. What's your view on these new age themes? Zomato, I think the other trigger, the technical point is that it could come into the F&O. If it comes into the F&O, then it will be eligible to come into the Nifty as well. That's what the street is hoping. Your view on these new age themes, some of these concept stocks, Zomato, Ola, a lot of them have done quite well. Your view?
Yeah, so I think some of the new age companies, okay, we've seen now they have come of age, right? In the sense that we are seeing profitability coming in both, say, at the not only the EBITDA level, but also the PAT level. So now they are, while their growth continues to be on the higher side because they're still in the early stage of their growth or probably the mid stage of their growth. But I think now we are able to value at least some of the companies which have now been there for some time and are turned profitable more from a traditional valuation matrices which are there. But I think then again in the new age company, we have to be careful in terms of really looking at whether the unit economics are really making sense, right? So if the unit economics are not in place and at the unit level you're not making a profit, then we would be slightly wary about that in terms of trying to enter that and taking any large position over that. But a lot of these names which are there, which have now established unit economics and have got the scale and size, and more importantly, established their dominance, okay, at least in that space where they are. So I think these companies are now where investors can really look at it. And obviously, since these are high growth companies, high value, we have to be careful in terms of when we are entering into. And on a quarterly basis, one needs to monitor in terms of what is their delivery, if they are really sticking to their growth or they're faltering, because here the volatility will be much higher, right? And if they falter on growth in any of the quarters, I think you could see a larger derating. So that's where investors need to really keep in track whether they are really tracking the kind of performance or the expectations which the market has from these companies.
The market's come off, right? I mean, 25 odd points is what you have on the index, 25,200. So just about holding. And we were saying this, I mean, the global picture is, I mean, at least the handover was better, but it's neither here nor there. Generally, the big data point out of the US is tomorrow's jobs number. And markets would be broadly quite wary about sort of going big one way or the other before that number. And that is only, of course, around the time that the US markets start to trade on Friday. So it's a bit quiet overall so far as far as indices are concerned. Edelweiss is now up 6%. So that's actually, flying now, 121 on Edelweiss. But there is so much more. Kaplan Point is up 4.5%. You've got Kernex, I mentioned. Craftsman Auto is up about 4%. So 62.52 on Craftsman. I could go down the list, but volumes are still about picking up. But this is the bulk of what is going on out there. Mahesh, just a quick view on banks, but more importantly, NBFCs, right? I mean, if indeed we are in that point where rates will start to come off, what do you think? should one stick with some of the larger banks? Or do you think it makes sense to look at some NBFCs, etc. as well? On the housing side, companies are keenly awaiting how this new PMAY 2 will work. So that'll be important for them. But generally, how's the environment? And what is a better bet right now? Some of the NBFCs or large banks?
Yeah, so I think one is, I think we are now getting into the rate cut cycle, right, which will start shortly. I think you will see that now in this month in the US, okay, the Fed move, I think that will kickstart the rate cut cycle. And that should be positive for the NBFCs, I mean, additionally, because where you will see them benefiting on the cost of fund side. But I think more important on the financial services side is to look at on the two aspects. One is on the asset side, right? So I think NBFCs, okay, which are, because asset quality cycle has been fairly benign at this point in time. And there are some pockets of risk which are coming up, okay, at this point in time, especially on the unsecured side, which one has to be careful. So I think NBFCs which are doing pretty, I mean, on the asset side, good underwriting, more on the secured book, right, which is the vehicle finance book or the mortgage finance book. I think the comfort would be much better. Also on the liability side, again, we've seen that there has been some of the challenges, at least on the bank lending to the NBFCs. So the stronger and the larger NBFCs, I think, are where they will continue to get advantage in terms of the liability side, both on the cost of funds and also in terms of the supply of funds over there. So I would say if you're able to categorize NBFCs, the larger ones, the stronger ones, okay, on the asset side, which are much secure lending, I think those should do fine in this rate cut cycle going forward. And as far as the banks have concerned, larger banks, I would say that the rate cut cycle plays out. You might see some margin pressure, okay, which could be there, but I think they have already kind of discounted, I would say, because the underperformance in bank for the last 1 year, what we've seen is pretty much there in the price. And it's more to do with your credit growth, how that picks up. I think that will drive the outperformance in the banks.
All right, Mahesh, we'll leave it there. Thank you very much for your time. It's really a pleasure having you here and getting that perspective across. So 27 points on the Nifty, so it's very, very quiet. I mean, actually, even off the day's high, so to speak. Well, let's focus on HDFC Life. The insurer had guided for a 15% APE growth in FY25. But with the first quarter earnings coming much stronger, my colleague Yash caught up with the company's MD and CEO, Vibha Padalkar, began by asking her if there could be an upward revision to that full year FY25 guidance from the 15% stated aim. Let's listen into some of that conversation.
As of now, given that there are some fairly significant regulatory changes on the anvil, we are holding what we said. Okay. Internally, of course, we're targeting a slightly higher number, but we had said 15%, which is on the upper end, on a full year basis. Yes, it's looking pretty good in terms of first 4 months, and like you said, upwards of 30%. But let's also be honest that there was a base effect. Correct. And so numbers for us and for everyone else is slightly looking more elevated. On a 2-year CAGR basis, it's in the mid-20s. And that's what, so it's not very different to where we are saying 15% internally targeting a little bit higher numbers. But I think I'll have a better view once the surrender charges and that new regulations are implemented. Lots of things will undergo a change. And I think right now we just want to go with focusing on business.
So 15% is the conservative view that you would want to share at this point of time. But there is an upward or a positive bias internally that you have.
I would think
correct?
So. All things being equal, on the regulatory front, 1st of October it comes into being, because then you can build a business model around it. And with very little in terms of further changes, then with the stability of business models, yes, there should be a bit of an upward bias on it.
Okay. A little on the value of new business as well. Do you expect that side, which will of course be a function of the margins also, but do you expect it to grow in tandem with the APE growth? And you've spelt out a 4-year target also towards that.
That's right.
But would it grow every year for the next 4 years in tandem with APE growth, or could it exceed that?
It's become a way of life that at least you will double your VNB every 4 years, regardless of the ups and downs. And there will be very young sector, and there will be something or the other that we have to look at from a business model change perspective. And so nothing has changed. That's what we have been delivering in cohorts of 4 years, and we will continue to deliver. Again, top line doubling and VNB doubling.
Okay.
And nothing's changed, and I want to assure you that nothing has changed. So I'm saying whether it's 4 or 4.25 years, so we are saying about 18%. Between 17 to 18% is 17.5, 18.5. That kind of a range is what we have been delivering, and that's what we are internally targeting.
Now, you've said in the conference call after the first quarter that you expect ULIP share to moderate. Now, I assume that significant part of that moderation, you are indicating that it will come because the other product categories will grow, will take a higher share, and not ULIP share will come down largely. In that situation, I want to understand, by the end of this year, with other product categories growing and taking a higher share, where do you expect the ULIP share to be over where you ended FY24? And in terms of margins, if that moves as per your understanding, the ULIP share, onto your margins, where do you see them? Where do you see yourself ending FY25 at?
I don't even have to wait till end of the year.
Okay.
We are already there. Okay, so happy to share that whatever we have said, that ULIP was elevated thanks to the markets. It's already coming close to about a third of our business. Some of our channels are sub 30%.
Okay.
Right, so it's already been achieved. Our non-par, I'm happy to share, is growing and in the first quarter itself grown by about 41%. We've already started demonstrating that ULIPs are quite at a range that we are reasonably comfortable.
ULIPs, of course, coming in the comfortable range. By the end of the year, by the next couple of quarters, which product segment do we see actually accelerating as a share of the individual APE where we stand today?
Definitely non-par. And like I said, we've just launched this blockbuster product. So that's showing very good traction. Also, in terms of the impact in the new regime, it's something that we have been talking to our partners and seeing how it can be mitigated. So if that settles down, then that segment should do reasonably well. Term is continuing to grow faster than company level growth, and so we had about 28% growth in term in the first quarter. On sum assured basis, very good numbers, about 46% on retail sum assured that we've shown growth on. So term should nicely continue to increase.
You've told me protection will grow. You've told me non-par will grow. You've told me ULIPs have come down. What does that leave you in terms of an estimation on the margins for the year?
This year, like I have articulated on our call, we're not tethered to a margin. Last year, we ended 26.3%.
Correct.
I don't want to be tethered, and I'll explain why. At the same time, the caveat is we are not looking to drop margins by 400 to 500, 600 basis points, which has not been unusual in our sector.
Correct.
So I'm not talking about that margins could be free fall as long as I give the top line, like I mentioned to you. That's not what I'm saying. Now I'm saying that, like in our earlier part of today's interview, that I will grow top line, I'll double over 4 years. I will do the same thing in terms of VNB.
Correct.
Margins will be range bound, give or take 26.3, 100 basis points, 150 basis points here or there. It could be, because my focus and the ranking of priorities has been top line growth, so that we continue to be slightly higher than overall industry.
Correct.
Second is VNB growth. Margins will be an outcome of that. Only reason I'm saying that is because of unit linked. The fact that equity markets are still very, very elevated, I don't want to say no to good business, although it comes in through the door as unit linked.
So, because you had mentioned that you'd be willing to trade off some downsizing of margins against growth, just to understand that downsizing won't be plus minus 100 basis points. Is that what you're saying?
No, I'm saying it could be 100 basis points lower.
Yes,
as long as I can give you the VNB growth.
what came in that strong story for protection that we were talking about, and do you expect this to continue for some time, or do you expect this to bounce back if it was just a one-off from the next quarter itself?
Yeah, so let me deconstruct it. Like you said, retail protection, very strong growth. Credit life was flattish, and hence overall number as a percentage came down.
Okay.
Credit life, there are 2 or 3 parts into it. So the MFI book is about 1/3. And we know that the pain, a lot of the MFIs went through in quarter 1 and are continuing to go through.
Correct.
Similarly, some of the NBFCs are also going through fair bit of pain. And we also believe in right pricing. So what is the pricing commensurate with the claims that we are seeing? That triangulation means that little bit of slowdown that we saw. On HDFC book though, we are fairly optimistic about getting a pickup in the second half of the year.
I know I've spoken to you about growth, but I want to make the month of September an exception. October is when the surrender value guidelines kick in. Simply, I will, of course, get to understand surrender value and its impact from you. But simply to put it that way, is there a strong sale from the end of your distributors before the new surrender value or the higher surrender value guidelines kick in? And in that sense, could September be a very, very strong month in terms of sales just on the back of making the most of the last 15 days?
It could be for the sector. It won't be for us. We will not do any fire sale. The paradox is these products, why is our regulator bringing out these changes? Because the products are going to be better for the customer. What is the implication of a fire sale? That means something good is going to go away and hence buy something in a hurry. The products are going to be more customer friendly. So we will stay away from a product sale. And we've had conversations with our partners that we will not do any fire sale.
Is the word coming in from Ms. Vibha Padalkar of HDFC Life. We'll take a break on that note, come back on the other side. And Arnab Banerjee, MD and CEO at CEAT, will join in to talk about the company's business outlook.
Welcome back. Well, keep an eye out on HAL. We had some flashes that were at the bottom of the screen for you. The GE Aerospace to commence delivering F404 jet engines this month. So that's the piece of news that's come in there. For the time being, the stock is a little bit lower, but those flashes were down for you on the screen. In a bit, we'll just try to address that piece of news as well. Well, CEAT, that's the next management on the show. The stock is up close to 20% in 2024, but the rising domestic rubber prices, well, they've been a bit of a headwind. In fact, we have rubber prices that are up 50% in 2024, though there were signs that it's cooling off a little bit from the top. To help us out with how are the demand trends, what's the volume guidance, and what does it mean in terms of profitability, we're joined by Mr. Arnab Banerjee, the MD and CEO of CEAT. Hi, Mr. Banerjee. Good morning, and always good to speak to you. Thanks a lot for joining in. Well, let's focus on the pricing side. You had hinted that price hikes are likely to be taken up. So could you tell us in Q2 so far, what are the price increases that have been taken? Are you intending on increasing prices yet again? If yes, by how much? So you're on mute. We'd like to listen to you. So, if you could unmute yourself.
Sorry, the price increase actually took off by the end of Q4. So if you track from April till July, August, we have taken up about 3 to 4% price hike already in truck bus radial, about 3% in passenger, and somewhat less, about 1.5% in the two-wheeler category. But it's inadequate to cover the raw material price hike. Natural rubber has been trending at 30 to 40% higher than what it was in Q4 base. And synthetic rubber and imported natural rubber, everything has moved up. So the entire basket has moved up. I think we should be taking another 1 to 2% price hike. It's required. And we plan to take some of that in the month of September itself.
Year to date, in this fiscal so far, it's around 3 to 4%, and you're looking to take another 1 to 2%, right?
Absolutely, that's replacement market. OEM price hikes come with indexation lag of 1 quarter, which is coming.
Got it. All right. I want to ask you about natural rubber prices. As you said that on a per kg basis as well, I was looking at the trend. I think it went from around 180 also to more than 200 on a per kg basis. You can correct me on that number. I think it peaked out at around 210 rupees per kg. So as of now, what is it? And what is the trend going ahead from here on?
See, it went up to 240, even 250, 260 levels also for a short period of time. It's around 220. As we move from Q2 to Q3, we will enter the tapping season. Right now also it's a low demand quarter, usually monsoons. So we expect this rate to stabilize at around maybe 200. It's anybody's guess. The problem is that we are a rubber deficit country and there are not enough stock available in the market, which is what is also fueling the price. So we had to resort to imports, which is covering the production requirement a little bit. But overall, I think taken together, we would expect it to stabilize by Q3, and then maybe hopefully in Q4, Q1, it should come down.
Sir, just want to get your sense on overall demand, because when we look at the aggregate numbers, we just got FADA numbers, retail level numbers just now, half an hour back. And the picture seems to be showing sluggishness. I'll just read out the numbers. Passenger vehicle sales, they're down 4.5% year on year. This is everybody aggregate put together. These are FADA numbers. They're down sequentially. Total retail sales are up only 2.8% year on year, down 7% month on month. And CV, of course, let's not even start. The CV cycle has been unimpressive for many months in a row. It's only the two-wheeler space that seems to be bucking the trend. Isn't there a demand concern that's building up? And are you confident of delivering this double-digit growth that you guided for earlier?
Yeah, so let me throw some light on the numbers that you just spoke about. Those were OEM sales number, right? So OEM business is about 25 to 27% of our portfolio. That is impacted by the numbers which you just shared, and they're correct. The replacement growth is somewhat better, right? And the rural growth, as I mentioned in the last conversation, it's coming back. If we look at our farm or two-wheeler sales, then the rural growth is actually higher than urban growth in replacement. This is happening after a long time. And we expect this trend to continue after the monsoons. About 55% of our sales is actually replacement sales. So that is where we expect a high single-digit growth in 2-3 wheelers, a mid single-digit growth kind of thing in passenger. And we expect the commercial vehicle space also to have good single-digit growth in replacement. As far as OEMs are concerned, we understand that the second half for commercial vehicles will be better. It's true that it's stagnated because of elections, and Q2 also is kind of flat. Two-wheelers are doing well, but two-wheelers are catching up on the pre-COVID levels now. And finally in this year, they will catch up with the pre-COVID levels of volume. And passenger is down on a very high base of last year. That's the OEM. We also have a 20% international business. So there the order books are looking good, very robust. We are growing in very, very high double digits in international. and we have a very strong outlook in second half. So overall, we maintain the outlook of double-digit growth in this entire financial year.
Mr. Banerjee, hi, good morning. On margins, sir, did you put out a number for 25? Would there be like 150 basis point compression over 24?
So first quarter numbers, it's impacted. The raw material price hike and the mismatch between the finished good price hike will continue in quarter two. So margins will be under pressure in quarter two as well. Then we will see if the prices moderate. Usually the margins come back in the second. It might come back a little bit up in the second half. Overall, I think it will be lower than last year.
Okay. Is there a sensitivity that we can work with? I mean, obviously, in terms of rubber prices and margins, how does it move? I mean, the relationship now, and has it become a bit more flexible as compared to the previous years? I mean, so it's not entirely dependent on how rubber prices move, or is it still as dependent?
No, rubber prices is about 30 to 40% of the portfolio of our RM basket. And if you look at the passenger segment, which is the two-wheelers and the four-wheelers, which is what is selling well in replacement and the international market. And for us in OEM also, we are looking forward to good growth in two-wheeler and four-wheeler in the second half because of the visibility of models and the brand fitment. So that is more dependent on synthetic rubber and less on natural rubber. Natural rubber is a bigger constituent of the truck bus radial segment, where we are a smaller player, relatively speaking. We have a single-digit market share. So to answer you directly, I think the degree of freedom for our portfolio vis-a-vis natural rubber is a little bit higher, but still it is significantly dependent. And we have to calibrate our price hike based on natural rubber price.
All right, Mr. Banerjee, so just to sum things up, in the first half of the year, things will be under pressure. Quarter one had some marketing cost, raw material costs were higher as well. So first half of the year, margins will be subdued with the recovery in the second half of the year. And put it for the year together, it should be 100 basis points lower than last year?
Well, I can't exactly say, but
directionally, it would be that way?
It is likely to be lower than last year, yes.
Got it. All right. Also, I wanted to ask you about the exports, because I think exports is margin accretive as well. So you said, I think it is around 20%, and the endeavor was to take it to around 25%. By when does that happen?
We have given ourselves 2 to 3 years time to make that happen. Actually, if you do the maths, 20 to 25% saliency increase means doubling export in 3 years. And we are gunning for that. And we are looking at LATAM, US. US, we've just launched the trucks radial, Europe, for 3 categories, which is agri radials, passenger radial, and truck bus radial. So we are on to doubling our turnover in about 3 years, which would lead to around 25% saliency.
Got it. There was some focus on EV tires as well, with platform wins, I think, in two-wheeler, passenger vehicles, and various other segments. Tell us, how much does it constitute of a total mix, and what's the the way ahead from there?
So right now, EV tires, for EV tires, we are looking at how we are doing in the OEMs, with the OEMs, the two-wheelers and the wheelers primarily. We are about 25 to 30% share in both two-wheeler and four-wheeler OEMs in EVs. The replacement market will pan out with a lag, and customer education is required, to buy the right tire for the right vehicle. So we are not really tracking that now, but we are happy with what we are achieving in the OEM segments.
All right, Mr. Banerjee, we'll leave it there. Thank you very much for your time, sir. Good luck to you and your team. Thank you. Just want to quickly pull up the market briefly. I think the Nifty almost went into the red, and then it did not. So we're up 20 points now. It's, of course, off the highs by 30, 40 points. But look at Zomato, which we were talking about earlier. It's a 6% pop on Zomato. So that's essentially the stock of the morning. The start was lower. It picked up, and that's a 14, 15 rupee sort of gain coming through on Zomato. The high, by the way, recent high was 280, 281. A bit of a frenzied move with all those calls, etc., coming through. And then it started to correct a little bit. So today it's seeing, once again, a bit of a bid. We'll take a quick commercial break here. We're going to come back. Okay, I think what we'll do is we will get you the next conversation, really. Anchit Nair is Executive Director and CEO Beauty at Nykaa. a face that you don't see very often sort of on media. Now, Nykaa is planning to open 40 to 60 stores every year, and a lot of these stores will come from smaller towns. My colleague Shilpa Ranipeta caught up with Anchit, began by asking him about the growth trajectory for the company. Listen to a slice of that conversation.
If you look 5 years ahead, by 2028, this market is expected to be roughly a $35 billion market. And online will contribute to roughly a third of that. And the remainder will be coming from the offline channels. So the category as a whole is growing at roughly 10 to 12% CAGR over the next 5 years. And this is the fastest growing BPC market in the world. Now, if I also add to that a layer of a per capita spend, if you look at it in India today, the average Indian spends roughly $15 US on beauty and personal care. 1.5. That is the lowest per capita spend in the world. So we always see this as we're in the earliest of innings in terms of our beauty and personal care consumption in India. This is a multi-decade growth story. And I think Nykaa, who plays a large role in growing this market. We have 200 stores across 70 cities. And we have 25 million plus customers on Nykaa app who are shopping from pretty much every pin code in India. So we've brought beauty to the doorstep of these smaller towns, and we've made it a lot more accessible and convenient for them to get the best global brands at the click of a button.
Right.
And I think that is also what has led to this accelerated growth in demand, even from the tier 2, tier 3 towns.
But how much then, I mean, how big is that tier 2, tier 3 town pie for you, both from an offline perspective and online? And offline, I mean, when you go to add more stores also, how seriously are you looking at that pie?
Yeah. We see a massive opportunity in these smaller towns. I think historically we've disclosed that 60% of our business comes from tier 2 and beyond. And that number has stayed relatively constant, but because tier 1 is also growing nicely. See, as I said in the beginning of our interview, that consumption in India is low in general. Even in tier 1 towns, the consumption is much below where it could be. So all tier 1, 2 and 3 cities are growing in terms of their awareness for this category as well as their consumption for this category. In terms of physical retail, as I said, we're across 70 cities today. And the plan is to get to about 400 stores across 100 cities over the next several years. So we're halfway there, exactly halfway there. If you look at our retail expansion, we opened 100 stores in the first 7-8 years of Nykaa's journey. In the last 2 to 3 years, we've doubled that. We've opened another 100 stores. And if I look ahead, we've said that about you'll see about 40 to 60 stores over the next several years, every year. And a lot of these will come from smaller towns because now we're quite well penetrated in the larger metros.
Right. And I want to talk about categories. That was another interesting thing. So in the report, it said skincare, makeup, hair care, fragrance are the fastest growing categories currently. Are these the fastest growing categories for Nykaa as well? And I just want to understand the kind of growth that you've seen in these, and how are you then playing to these categories? Is fragrance one breakout opportunity that is there for you as well?
So for us, makeup and skin have always been large categories. Fragrance is a unique opportunity for us because Nykaa is seen by the consumer as a trustworthy platform. A lot of horizontal marketplaces in India are open marketplaces. And therefore, the authenticity of the product that is being sold can never be guaranteed.
Right.
Whereas us, Nykaa, as a inventory-led model, we are buying directly from the brands. And so the product which we retail on our platform is 100% authentic. And I think that is an important peg, especially when selling high ASP items like fragrances.
Right. I mean, how do you see the mix between these categories then going forward? I'm talking about the sales mix.
Yeah, so I mean, makeup, I would tell you pre-pandemic, makeup was 60% plus of our overall business. Today, it's a third of our business. Skincare has been the big standout over the past 5 years.
Yeah. And, given the opportunity that you've outlined in the report that's there for growth in the beauty market, how do you see the average basket size per order then now going ahead in the medium term?
The basket size of the repeat customer is growing with every subsequent purchase. And that is the beauty of a platform like ours. We're able to, through education, through content, through assortment, continue to increase the size of the basket of our repeat customers. New customers, on the other hand, are new to the platform. And in many cases, they're new to the world of beauty. So their basket size might be slightly smaller than that of a repeat customer. But that's where the Nykaa magic kicks in. That's where once they've made their first purchase, we are able to really influence them to drive them to buy more items with every subsequent transaction. So the average basket size of repeat customers is growing nicely, average basket size of new customers is growing nicely, but at a consolidated level, it's an output of how many new customers versus repeat customers are shopping on the platform.
Okay.
So 80% of our business comes from repeat customers. How deeply penetrated the repeat customers are.
Right.
So it's a very healthy mix. If you look at our business having a strong repeat base of consumers and at the same time acquiring millions of new customers, it's a very healthy mix.
Right.
So yes, to answer your question, ABS is increasing for both customer segments.
Right. Fair enough. And you know, the other very interesting piece I want to talk about is prestige beauty, something that's also addressed in the report. Can you sort of tell me currently what's the landscape in India when it comes to prestige beauty brands? Nykaa has brought in a lot of brands globally. How are global brands looking at India? What's the sense that you get? And many have come to India. How has the growth of those brands been? And then going down the line, can we expect more partnerships?
The competition is heating up for prestige, and on top of that, Nykaa is bringing a lot of prestige brands, a lot of brands. So yes, over the next decade, we see prestige beauty as growing much faster than the rest of the category. So that's where a lot of growth will come
from a sales mix,
from.
how much do prestige brands bring in for you currently? And you didn't touch upon more partnerships in the pipeline.
So, you know, again, this is something which we've disclosed in the past, so I can only refer you to the numbers we've disclosed in the past, which is roughly 15 to 20% of our business comes from prestige brands.
Okay.
By value. So it's a significant share, and it's growing faster than the platform. You know, over the past several months, we launched brands that you saw on the platform, whether it be Fenty Beauty, as I said, YSL also launched with us exclusively, YSL makeup from L'Oreal. Urban Decay was another brand which we bought in, Sol de Janeiro. And now, you know, we don't like to obviously disclose which brands are coming, but you will see some also launching very, very soon.
All right. Well, that was Nykaa, and we have Raymond Lifestyle finally making its debut on the street. There you have some visuals coming in as well. And look at that. The listing has happened northwards of 3,000. Which is already a doubler, near doubler from that issue price of 1,563. So that's Raymond Brands, which has the entire the lifestyle business, which is branded apparel. It also has the fabrics business and of course the suitings business. Well, with that, let's quickly head back to our technical experts and take stock of the market and the kind of trades we can look at. Mitesh Thakkar is with us. Mitesh, so the market seems to be, holding up, but with a very feeble gain now. So that opening pop is not really lasting. What would the trades be now?
I would agree. I think it's still the breadth which is showing more momentum. And, CEAT has just made a fresh high. That's a buy with a stop below 2950. Look for targets of 3120, 3150. So that's doing very well. And the other stock which I have is more of a sell call. NTPC, I think, is not participating in the last few days. There are signs of profit booking happening over here. So keep a stop at about 407.5. Look for targets of 395.
Okay, all right. Mitesh, thank you very much for that. We'll take a break. Manisha will be here to run us through the commodity picture. Stay tuned.
Welcome back. Let's shift focus to the commodity market now. We have Manisha joining in with the latest. Manisha, so what's catching your attention this morning?
Well, it is about the metal prices. You know, today is a steady day and you have seen mixed moves coming in from the metal prices. But if you look at a week-on-week basis, it has been a sharp decline from this sector. Well, to begin with, it has been weak China PMI numbers for manufacturing and services also. And then the street is now anticipating a smaller 25 basis point of a rate cut when we see the Fed meeting happen in the mid-September there. If you look at the prices onwards, then nickel is now trading at a 4-week lows. Well, the prices have seen a decline of almost 23% in the last 12 months itself. Not just nickel, silver prices also are trading at a 3-week lows, and we have seen prices decline onto this one as well, almost off by nearly 7% from its recent highs. The weak US data, the expectations that the solar demand could actually see not as expected growth also is weighing onto the markets. Copper is another one, and it already has seen a decline of 3% for the month of September so far. We have seen inventories continue to gain in China and on LME, and then a BHP statement downgrading the China demand by to almost 1 to 2% for this current year also has been weighing in. Also, when you look at the Chinese inventories, they have been on a surge. The Chinese exports have been on the higher side. Funds seem to be closing on to long positions that they held since the month of April, also is weighing onto the markets. And then you have platinum, that one is trading at a 4-week low. Steel prices have continued to decline. It's down by 23% on a year-to-date basis. And the zinc prices have declined as well. This is because of the supply surplus that the street has seen in the first half of this year, much higher than we saw in the previous year, also has been weighing onto the markets. Well, there has been an interesting report that came in from Goldman Sachs, which says that they have advised exiting long-term bullish cues in sense of copper there. They also have cut the price forecast that they initially put out for the year 2025 by $5,000. Remember, we did see copper prices at an all-time high in the month of May at $11,100. Currently, we are trading at below 9,000. Now, Goldman Sachs has come out with a report suggesting that the copper prices will average to $10,100 in 2025. Earlier, this was $15,000. So that's $5,000 of $5,000 per ton of a cut coming in from Goldman Sachs. Not just copper, Goldman Sachs also is putting a lower and a revised outlook for 2025 for aluminum to 2,500 from 2,850 there. They also are bearish in sense of nickel and iron ore going forward in 2025. The only one thing that Goldman Sachs has put out a report suggesting that they are bullish is in case of gold. They expect an all-time high of 2,700 onto that one in the next year. I will quickly put out a table showing on what the metal prices have done on a week-on-week basis. And as you can see, it all has been on the negative side, with larger cuts coming in for steel and nickel, more than 5% of a cut there, but 2 to 3% of a decline for copper, aluminum and zinc as well.
All right, Manisha, thank you very much for that. So that's commodities in focus. What's happening with Zomato? That's the stock of the day, stock of the morning. Too early to say stock of the day. But Vivek is here with what he's picking up. Vivek, morning.
Well, good morning. That's right. A very interesting note by JP Morgan today. They've gone ahead. They've maintained their overweight stance. They've raised the target price to 240 from the 208 they had earlier. They're saying that, it's spearheading a rapid retail consumer transformation via its convenience as well as selection-focused quick commerce business with ambitious rollout plans. They're also saying it's going deeper across all metros, having proven the model in the NCR region as well. And they're saying that the scale should help it drive monetization from channel margins as well as ad spendings. They're saying the Blinkit now has the license to scale up much faster than peers and the current target. So, higher target price as well as increased focus on profitability as far as the unit economics is concerned is something that's keeping the stock quite active in the session today.
Okay, all right, got it. Thank you very much for that, Vivek. Well, let's go across to Abhishek, because this Goldman Sachs call on Chola seems to be working really well for the stock. Abhishek?
Well, Goldman Sachs has initiated on Cholamandalam as well as AU Small Finance Bank. With respect to Chola, they have a buy rating and a target price of 1,786 per share. They say that market share gains is seen in Cholamandalam, especially with respect to commercial retail upcycle that has picked up. So scaling up the non-vehicle business over there should help the reduce cyclicality as well as improve the visibility of earnings growth along with better return ratios. So they expect an EPS CAGR of 33% over FY24 to 27, wherein they expect the ROA of the company to improve by 24 basis points in the same period, driven by the fact that there will be robust loan growth as well as market share gain across product segments. Goldman Sachs has also initiated coverage on AU Small Finance Bank, wherein they have a buy rating and a target price of 831 per share. They say that AU Small Finance Bank is ready for the next inning. Sector leading EPS growth is seen over here. So they forecast an EPS growth of 27% with respect to CAGR over FY24 to 27 and an improving ROA profile, wherein they estimate the ROA to improve by 14 basis points over the next 3 years, which will be driven by the robust loan growth seen in commercial retail portfolio, which is around 70% of Q1 FY25 loans, despite a normalization of the credit cycle with respect to NPAs. So AU Small Finance Bank is relatively better placed in this cycle, given the fact that there is improving deposit market share, better asset quality growth, as well as, operating efficiency gain, which will come despite the merger that they have done of Fincare Small Finance Bank. Back to you.
Okay, Abhishek, thank you very much for that. So that's Cholamandalam, which has been moving up on the back of that brokerage note. Let's now go across and get details from the new listing. Raymond listed its lifestyle business just a while back, and our colleague Shilpa caught up with the Gautam Singhania, MD of Raymond, to get a sense on how the business will grow from here on.
Congratulations on a wonderful listing. Firstly, just your thoughts on this incredible milestone. Raymond now has 2 listed entities. Just quickly tell us how you're feeling with Raymond Lifestyle now officially on the stock exchanges.
No, it's a great feeling. Always wanted to create shareholder value. And today is a historic day in Raymond. So with the listing of this company, I think we've got a great runway ahead.
Right. A great runway ahead is what you've mentioned, and lifestyle business turning 100 also. Sort of give us a sense then this year, what is the big growth, driver that we can expect from Raymond Lifestyle? Will it be the wedding business? Is that going to be and how much of a share are we looking at on that front?
So the wedding season is strong. As we said, coming up for the next 6 to 9 months, we should have a very strong wedding season. So that should drive strong growth.
Right. And how are you leveraging the Bangladesh opportunity also for the garmenting business? How big do you see that being?
Well, I think the Bangladesh opportunity is great. It's a good opportunity for us to take advantage of. And it's just playing out, so let's see how it goes.
And you've guided doubling your EBITDA also in the next 4 years. What do you see really driving that?
Well, there's a whole business strategy for that.
All right. Thank you so much.
All right, so that's Raymond Lifestyle starting its journey as an individual entity on the bourses, and a big listing there with prices going over 3,000 rupees per share. We'll take a break on that note. Time for that break. After we come back, Lata will connect with Ajay Kamal, MD and CEO of Jana Small Finance Bank, to talk about the company's business outlook.
मैं डायल कर देता हूँ.
Today on our radar is Jana Small Finance Bank, a bank that is slowly making its journey from unsecured microfinance loans to secured affordable housing loans, loans against property. So it's an interesting journey. The bank in its first quarter reported 88% growth in profit, 8% net interest margin, 2% return on assets, all good. But the gross NPAs also shot up 30%, obviously due to problems in the MFI space. We know that the entire sector has its own problems. For a detailed look at this bank's journey towards secured assets, I have with me the big man himself, Ajay Kanwal, Managing Director and CEO of the bank. Ajay, thank you very much indeed for coming by. Well, let me start by asking you, let's first get this difficult part out of the way. MFI. We saw it in other banks, Credit Access, Grameen, Bandhan, everywhere the MFI sector has been in a spot of bother. For you, it is a receding part, but it is still a part. Can you tell us at what stage it is? How bad is the MFI sector? How many more quarters?
Okay. So, Lata, thank you for having me. And first, for all viewers, while the gross NPA has gone up, the actual gross NPA percentage is 2.5%. Yeah. And the net NPA...
The numbers are running as you talk.
Yeah. So, I can see that there. Net NPA is 0.95. So, I think this 30% jump tends to make it look a bit more bulgy. But at 2.5%, it's good for a institution which makes 8% net interest margin. So, back to your question, Lata, on MFI. So, I do think that a couple of things have got together. I think first is a heat wave causing a challenge amongst employees. Employees figuring out that that's not the best job. We've seen an increase in our attrition rate last quarter to this quarter, same time in the year. Second really is there is a real challenge in where some parts are over leveraged. And I think that is largely led through more discipline required at the MFI end. A combination of those two has led to slippages. I do think slippage will continue for this quarter. And after that will be stable. Okay. Because see, if you look at March and June, what has changed? The only thing we will say is heat wave. I didn't see any impact on our book on elections. So that's not the issue, right? But I do see that if you see continuously over the years, increase of average ticket size, so the lending amount is going up. You can see a very fast run in the industry. It's at 25% CAGR. And fundamentally unsecured, bottom of the period, 25% CAGR. Doesn't really say that it's moving at a pace it should move at. Okay. My bias would should move a bit more slowly. I mean, a good 15-20% grow steady over the years may have been a sensible answer for all of us. Okay. But I guess it goes through its cycle. It goes through the bump. You clear the bump, move on. And microfinance is never for the faint-hearted anyway.
Okay. No, of course not. But it's also, it has a bit of social purpose also to it. At least from Ramesh Ramanathan days, there was a social purpose. But Ajay, what is the percentage of your book now in MFI? How much has it traveled from a year ago to now? So, Lata, we launched the bank with 100% MFI. We're down to 38%. And out of the 38%, 8% is with the banking correspondents who tend to be very local and very good players. So, yes, our journey is to make it 80% secured bank. Okay. We are at 62. Okay. Another 2-3 years of work. And then we should get there. Okay, now about the secured portfolio itself, can you tell us more about affordable housing? The government has gone ahead with its Awas Yojana. There is a third avatar coming up. Is that helping? What kind of growth do you see in the LAP, affordable housing, in all those portfolios? So, Lata, when we started the bank, we looked at penetration of home loans in the upper end of microfinance customers, which you can broadly classify as middle India. Penetration was just 1%. Yes. Now, if somebody wants 5 lakh, 10 lakh, 15 lakh rupees, the most logical place they could probably go to was an NBFC. There was no any significant size even bank. Today, that's the only place.
Right. So we figured out that, listen, at the end of the day, we know customers. We are very good in last mile. We are fully digitized. We need to meet customers' financial needs. Financial inclusion doesn't mean unsecured loans. It could very well mean that I will help you, build your first floor. I'll help you build, cement your house, buy a new house. Yeah. So went into affordable housing. Our affordable housing ticket size is 12 lakh rupees. We are in 180 different cities across the country. We've been doing this business since 2018. So it has seen the COVID cycle also. Okay. Between our micro LAP and affordable housing book, it's a 10,000 crore book now, as we speak. and it's growing. It's the fastest growth engine we've had.
Okay.
Because if the company grew.
Yeah, if you have to split your 2.6% GNPA, how much is in MFI? Who are the sectors contributing to it?
So, roughly about 30% of our GNPA is now in secured. In secured, we have property backing it. So, about 52% is loan to value. So, we'll recover all the money. It's a timing matter.
Okay.
And the rest is in unsecured, out of which a large proportion is with BCs. So, I think they will bear a brunt of the challenge.
Okay.
And about 30-odd%. But remember, our PCR is in the 80s. So, very well covered on the provision on the unsecured side. So, there is not really a...
So, even with this one more quarter, which you say could be difficult for MFIs, where does your NPA peak, you think?
So, here is how I would say it. You know, we have, last year our credit cost was 1.96.
Okay.
This year we have said we will be in the 1.6, 1.7% range.
Okay.
And sitting here in September, I can tell you that we will be meeting those targets of 1.6, 1.7% of credit cost.
Okay, so you've peaked off on credit cost.
Yeah, two reasons. See, our average ticket size is lower than industry in microfinance. Our growth rate has been slowest. If you take Jana's growth from the day we started the bank, 6 years and 1 quarter, it's less than 2% CAGR.
Okay.
So we've always been clear in our
Careful
heads
in the
that, listen, this is not a business we want to run very hard on.
Okay.
We entirely graduated towards secured.
Okay.
And like you said, social purpose, you know, we moved away from consumption to lending for businesses.
Yes.
We are lending for affordable housing. We are doing two-wheelers. We are lending to MSME. So it's a whole different institution now.
Okay. Let me come to the cost of money. You said that your cost of funds is lower than others. What is the breakup? And now, will it willy-nilly your cost of funds go up? Have they gone up for Q2?
Okay. So Q2 is public. I've cut my deposit rates. My peak rate was 8.5% in quarter 1. It is 8.25 from 1st of July.
Okay.
I can also see the market is, the peak fights rates have come off across banks. So I would think that cost of funds have kind of peaked out. I guess not just for us, for everybody.
Even the likes of HDFC are giving 8+ in some buckets.
Yes.
Of course, large loans, large deposits.
So here is how I'd say. I think the gap, see, if you're a small finance bank launched in 2018, people don't know you, it's another level of premium they would expect.
Yes.
6 years later, listed bank profitable, then the premium obviously narrows, rightfully so. And existing customers are more
So your average cost now is 8, you would say?
8%.
For incremental.
But listen, we are a bit more, our LCR, which is the norm of how stable is your money, is above 300%. The RBI norm is 100.
Yes.
Industry average is 130. 132 if I'm correct. Now we've chosen to do a lot of non-callable and more than 1 year tenors.
Okay.
Because listen, what we don't want to do is look back and worry about liability. So I rather pay 20 bips extra and be in the high zone of making sure my deposits are more stable.
Okay. So will 8% be manageable, the margins?
So our NIM is 8. I do think it will remain in the same range. Purely because we are a retail business. And even an MSME, my ticket size are 40 lakhs.
Okay.
So I don't see how margin compression is not what we are seeing. What I can see is, you know, it's there is no more lazy banking as an option.
Of course not.
As long as you're working hard, you're going out meeting customers, there is so much business. And Lata, I must say the amount of business we see in the small and medium enterprises is really very good. I mean, I'm amazed the amount of orders. If you're in the defense supply chain, you are in the solar supply chain, you're in the EV supply chain, if you're in the infra supply chain. I mean, because we can't certainly finance infra, but we certainly finance all the supply chains of smaller enterprises.
Yeah.
I think there's a boom going on.
I noticed that your cost to income has actually fallen a bit to 55 from 56 and 58. What is the investment in technology? Because that will, the digitization of so many things and digital footprint should make lending more safe. So will this cost to income come down or go up actually?
So first is fully invested in digital. And luckily, and you mentioned Ramesh's name, I must give him credit. In 2014, he gave IBM the contract to set up a single, the single technology provider. That backbone hasn't changed. So 98% of savings is digital. Our affordable housing loans, same day sanction, with no compromise on process because it's end-to-end digitized now. So I think digitally we are well invested in, but we would never say never, so it keeps going on.
Okay.
Cost income is a function of the way we think about cost. So we are very, very frugal.
Okay.
We have basic disciplines, Lata, and I must tell you, coming from a foreign bank, it's been a tough one. We have no cabin policy.
Okay.
We have no business class travel. We don't have zonal offices.
That
we are
makes
fully
you
digitized.
similar to TV18, I must say. We have no cabins, no business travel. A very quick question.
Yeah.
Your peer company, AU, has applied for a universal bank license. Is that your final goal?
So we
and how many years away?
We have said, Lata, that there is one condition that we have to meet, which is net NPA has to be less than 1% for 2 years in a row. That's one condition we have met last year, but we need one more year.
Okay.
After that, we certainly would like to go on that path.
Oh, that's interesting. It's going to become a trend. Ajay Kamal, out of time. Thank you very much. It was a pleasure. And thank you for dropping by in our studio as well.
Thank you so much.
That's the word coming from another small finance bank. Goal ultimately is to get universal bank license and good on several parameters. We wind up Bazaar on that note. Short past is coming.